This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, August 14, 2026, and this is the After Hours session. Now, let's get into it. The crypto market is currently trapped in a deep pocket of risk aversion, with the fear and greed index plummeting to an extreme 14 out of 100, while Bitcoin's dominance expands to 56.12% as altcoins bleed. Yet beneath this veneer of capitulation, we see a stark divergence. Spot prices remain relatively sticky, while Bitcoin futures demand collapses to 2024 lows. And in the background, a massive structural shift is underway as PayPay, a key player in the Japanese crypto ecosystem, files for a $1.1 billion Nasdaq IPO, bridging the gap between Wall Street and digital assets. Looking ahead at the economic calendar for the next 48 hours, the market's attention shifts to U.S. consumer data. Tomorrow, Friday, August 14th, retail sales figures are released. This is a critical gauge of consumer spending power. Given the current extreme fear sentiment, weak data could exacerbate the risk-off tone, while strong numbers might provide the spark needed to stabilize equity-linked crypto assets. Following that, later this week, the Empire State Manufacturing Survey provides insight into industrial sentiment. For the crypto channel, these metrics matter because they dictate the broader liquidity environment that influences institutional appetite for high-beta assets like Solana and Avalanche. Apex, what is the single biggest variable to monitor in this data set?
It's the correlation or lack thereof. We have the VIX at 14.55, suggesting equities are complacent while crypto is screaming extreme fear. If retail sales come in hot, don't assume equities will rally crypto. Instead, look for a flight to quality where only Bitcoin and perhaps Ethereum benefit, while smaller caps continue to languish. Watch for that divergence, not just the raw number.
Let's set the stage with the current landscape. As of Friday, August 14th, 2026, at 19:04 ET, the total cryptocurrency market cap stands at approximately $2.24 trillion, with 24-hour volume hovering around $48.1 billion. Bitcoin leads at $62,831, down less than 1%, while Ethereum sits at $1,877.99. The breadth is poor. Uniswap is off nearly 8%, Aptos down almost 4%, and Litecoin off more than 2.5%. Yet we have pockets of green. ICP is up 2.5%, and Chainlink is up 1.1%. The narrative here isn't broad-based growth, it's a selective rotation. Let's dig into the drivers. 3 headlines are shaping this session. First, CoinDesk reports that PayPay, which owns 40% of Binance Japan, is seeking up to $1.1 billion in a Nasdaq IPO. Second, Cointelegraph notes that Bitcoin futures demand has fallen to 2024 lows, raising questions about institutional exit. Third, and perhaps most volatile, Cointelegraph reports that Iranian crypto outflows have spiked 700% following U.S.-Israeli airstrikes. Pulse, how does the PayPay IPO landing sit within this climate of extreme fear? It's a fascinating dissonance. On one hand, you have the fear and greed index at 14, reflecting a wholesale retreat of retail confidence. On the other, you have a major payment processor going public on Nasdaq, signaling deep institutional integration in Asia. Retail is panicking about daily volatility, but institutional capital is building the plumbing. The sentiment isn't just bearish, it's fragmented. The fear is concentrated in speculative layers, while the infrastructure layer is being validated by traditional finance listings. And the geopolitical angle. CIPHER, walk us through the flow implications of that Iranian outflow spike versus the broader futures demand collapse.
The Iranian outflow is a liquidity shock, not a market signal. 700% increase in outflows from a sanctioned region creates immediate, chaotic arbitrage opportunities and exchange-level stress, but it doesn't reflect fundamental demand for Bitcoin or Ethereum. Contrast that with the futures data. Bitcoin futures demand is at 2024 lows. That's a deliberate, structural deleveraging by institutional players. They aren't fleeing the asset class entirely, they are shedding leverage. The spot price of Bitcoin holding at $62,831 supports this. If they were truly exiting, spot would be cracking harder. This is a hedge unwind, not a fire sale.
So the exit narrative might be overstated. What about the political side? The U.S. Senate housing bill includes a CBDC ban. SPECTER, is this a tailwind or noise?
It's a tailwind for sovereignty narratives, but be careful not to confuse regulatory clarity with price action. The CBDC ban reinforces the hard money narrative, which benefits Bitcoin and Ethereum fundamentally. However, right now, with the VIX at 14.55 and crypto in extreme fear, this news hasn't triggered a relief rally. It's being absorbed quietly. The risk isn't the policy itself. The risk is that, while politics aligns with crypto, macro liquidity remains tight. Don't let the good news distract you from the fact that Uni is down 8% and the broader market is bleeding beta.
Let's break this down by asset class, starting with Bitcoin. It's at $62,831, down 0.8%, but holding 56.12% dominance. Grid, what is the technical posture here?
Technically, this is a classic flight to quality. Bitcoin is declining very slowly, minus 0.8%, while the alt market collapses. The dominance chart is rising steadily. At $62,831, we are seeing a consolidation zone. The lack of a sharp crash suggests that sellers are exhausted at this level, but buyers aren't aggressive enough to push it higher. The key observation is the volume profile. It's thin. This isn't a breakout pattern, it's a coiling spring. The support at 62,831 is holding, but it's fragile because it lacks heavy buy wall confirmation. It's holding because there are no active sellers, not because there are strong buyers.
I agree on the fragility, but I want to clarify the source of that hold. The spot holders are passive. The active participants, the ones moving the needle, are reducing their futures exposure. When you combine Grid's observation of thin volume with my data showing futures demand at 2024 lows, you get a market that is directionally uncertain. The price is stable because leverage has been removed, not because conviction is high. If volume spikes suddenly, either direction is possible, but the current Grid is essentially empty.
And that emptiness is the danger. Grid, you call it a coiling spring, but with the VIX at 14.55, that coil is rusted shut. The low volatility in equities suggests the broader market is unaware of the internal pressure building in crypto. If a shock hits, like a negative surprise in tomorrow's retail sales, that fragile support at 62,831 could vanish instantly. We aren't looking at a gentle consolidation. We're looking at a liquidity vacuum. The absence of sellers is temporary.
Turning to Ethereum. It's at $1,877.99, down 0.5%. How does Ethereum compare to Bitcoin in this rotation?
Ethereum is lagging Bitcoin slightly in relative strength. While Bitcoin is defending 62,831, Ethereum is drifting lower at 1,877.99. The ratio is weakening. Technically, Ethereum needs to find a hard floor soon. The $1,863 low from earlier today is the immediate test. If that breaks, we're looking at a deeper retracement. Unlike Bitcoin, which is supported by its status as digital gold/sovereign asset, Ethereum is more sensitive to decentralized finance and smart contract sentiment. With Uni down 8.1%, the ecosystem sentiment is toxic right now. Ethereum is caught in the crossfire.
That toxicity is measurable in the TVL flows. Capital is leaving speculative decentralized finance protocols and moving into staking or stablecoins. The 1.1 billion PayPay IPO is interesting for Ethereum indirectly. It brings traditional finance users into the ecosystem, but they tend to stick to Bitcoin or stablecoins initially. Ethereum's upside requires developer activity and decentralized finance innovation, both of which are currently sidelined by the fear. Until Uni and other decentralized finance tokens stop bleeding, Ethereum will struggle to lead.
Let's talk about the laggards. Uniswap is crashing 8.1% to $3.2. Is this a sector-wide issue or specific to Uniswap?
Uniswap's breakdown at $3.2 is a technical failure of the lowest degree. It has broken key local support levels, and the volume on the decline suggests institutional distribution. This isn't just retail fear. Large wallets are exiting positions. The pattern is a classic descending wedge failure. Unless it finds support somewhere else, the path of least resistance is lower. It's isolating the decentralized exchange narrative from the rest of the market.
And that isolation is the real risk. When a leading decentralized finance protocol like Uniswap gets hammered this hard, it triggers a contagion effect. Traders assume if Uniswap can lose 8% in a down day, others will fall harder. But here's the contrary view. If Uniswap bottoms here, it could be a capitulation point. However, watching the VIX at 14.55, I suspect we're not there yet. The market is still complacent. This drop feels like a slow leak, not a pop. Keep your distance until volume stabilizes.
Now, let's look at the bright spots. ICP is up 2.5% to $2.23, and Link is up 1.1% to $8.94. Grid, why are these two outperforming?
These are the picks and shovels of the current cycle. Link, as an Oracle network, is essential infrastructure for decentralized finance and Web3 integrations. Its gain of 1.1% in a sea of red confirms it has independent demand. ETH, representing decentralized compute and storage, is benefiting from a narrative shift away from simple smart contracts toward utility. Technically, both are forming higher lows while the broader market forms lower highs. They are decoupling. This is a clear signal of capital rotation into infrastructure rather than speculation.
I'd add that the flows into ICP and Link are coming from different sources. Link's inflows seem to be from enterprise partnerships and Oracle integrations, which are slower, steadier flows. ICP's surge is more narrative-driven, likely tied to recent announcements about decentralized storage capabilities. Neither is driven by retail fear of missing out. These are institutional-grade rotations, while Uniswap bleeds. Capital is moving into assets that solve actual problems in the stack.
And sentiment-wise, this is crucial. The retail crowd is scared of everything except infrastructure. When I look at community discussions, there's a growing fatigue with meme coins and speculative L1s. Investors are tired of getting wrecked, so they're parking money in Link and ICP because they feel safer. This isn't greed, it's a defensive posture. The extreme fear at 14/100 is pushing capital out of risk and into perceived security, even within crypto.
Finally, let's address the volatility paradox. The VIX is at 14.55, extremely low, yet crypto fear and greed is 14/100, extremely high. Apex synthesized this conflict.
This is the core tension of the current market. Grid pointed out the technical fragility of Bitcoin, and CIPHER highlighted the future's deleveraging. Together, they paint a picture of a market that is technically stable but structurally hollow. The low VIX means equities aren't providing a tailwind, and they certainly aren't acting as a shark absorber for crypto volatility. Instead, we have a divergence. Equities are asleep, crypto is awake and terrified. Usually, when VIX is this low, crypto follows suit and becomes complacent. Here it's the opposite. This suggests the next move in crypto will be independent of, and possibly adverse to, the equity market. If equities wake up, they may not save crypto.
SPECTER, what's the risk scenario here? If VIX stays low, does crypto explode?
Not necessarily explode, but it can unwind violently. The 700% spike in Iranian outflows is a wild card. If that creates exchange liquidity issues combined with the zero leverage buffer from the futures crash, we could see a flash crash that bypasses all technical support. The calm at 14.55 is deceptive. It's the eye of the storm. My concern isn't a slow grind down. It's a sudden liquidity dry up. Watch the depth charts, not just the price.
CIPHER, any final thoughts on the PayPay IPO's impact on these flows?
It's a long-game signal. The IPO itself won't pump Bitcoin tomorrow, but it proves that the infrastructure connecting traditional finance to crypto is expanding. Over the next quarter, as PayPay integrates its services, we'll see more steady, predictable liquidity entering the Asian market. This counters the capital flight narrative. It's not all outflows, some of it is structural integration. Just don't expect it to offset today's fear.
We've covered a lot of ground. Grid, CIPHER, Pulse, SPECTER, Apex, you've all weighed in on the divergence. Give me the bottom line. what is the state of the market right now?
The market is in a wait-and-see consolidation with hidden fragility. Grid identified the technical stability of Bitcoin at 62,831, but CIPHER reminded us that this stability is built on reduced leverage, not strong buying pressure. Pulse noted that retail is in extreme fear, driving a rotation into safe haven infrastructure like Chainlink and ICP, while SPECTER warned that the low VIX environment means any shock will be amplified. The consensus is, SPART is holding but the foundation is shaky. Watch for volume confirmation.
And for the traders listening, what's the key takeaway?
Don't chase the pumps. The fear is too high, and the sentiment is too brittle. Stick to the infrastructure plays that are showing relative strength.
Monitor the basis. If the spread between spot and futures widens further, it confirms the institutional deleveraging. That's your signal to adjust position sizing, not to exit entirely.
Respect the silence. The market is quiet, but it's not sleeping. Prepare for volatility, not direction.
To summarize, Bitcoin holds steady at $62,831 amidst falling futures demand, signaling institutional deleveraging rather than capitulation. Altcoins are suffering as capital rotates into infrastructure names like Chainlink and ICP, while the broader market remains paralyzed by extreme fear at 14/100. Tomorrow, watch the retail sales data for clues on whether this consolidation will hold or break. Thank you for tuning into the ShadowQuant Crypto Edition After Hours. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.